This week we'll try to answer the question, are markets in the early stages of a peaking process? We do have competing forces with the Fed wanting to inflate asset prices, action between risk assets and risk-off assets, such as stocks versus bonds, in the last week are pointing towards the potential for a pullback. The odds of a pullback have increased substantially over the last 5 trading sessions. A week ago, we mentioned that a give back will come at some point. S&P 500, even under a reversal scenario, could easily see it pushing to 1470 to 1500 if we have some type of intermediate peak. And an intermediate peak might be something like a 3 to 5 day pullback, which would be similar to the pullback that we saw in November of 2010 after QE2 was announced. A peaking process or an intermediate top could occur anytime over the next few trading sessions in late September, but more likely would occur sometime between, let's say, October 3rd and October 19th. We'll discuss where those numbers come from in the video. If we make it to these levels and pull back, there's support in the 1428 area on the S&P 500. If that gives way, we could see the market easily correcting back to 1390 or 1389-ish. Longer term, the charts still look good. Spain, from a fundamental perspective, is a wild card. If Spain requests a formal bailout, that could push markets higher. Once Spain has cleared themselves with European policymakers, we'll have simultaneous money printing going on from the Fed and ECB. The ECB is not printing yet. They've just said that they're willing to print. Spain can change that, and if we get this bullet down here, some of this could be wiped out. But the current track looks like a pullback. In the charts that we'll review, we'll try to discern between these 2 bullet points, what to look for, what would look bullish, what would look bearish, some resistance levels to watch, early warning signs. We already have them. So as we mentioned, the current track looks like a topping process where the market could roll over. And we'll also point out some things to look for to negate our concerns where we might be able to push to higher highs. Last week we also mentioned that the charts are like a temperature gauge in your car, that they don't predict the future. I think it's fair to say that the temperature gauge was here a week ago, but after the last trading week, I think it's more in this range here. We haven't overheated yet, but we need to have contingency plans in place, and there's no question that the risk-reward ratio in risk assets is less favorable than it was a week to 10 days ago, and especially it's less favorable relative to what we saw 3 months ago. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. We're showing some potentially bearish setups and developments here, but they easily could be wiped out. So it's important for us to maintain maximum flexibility. We don't care if the markets go up. We don't care if they go down. We just want to be aligned properly and aligned relative to what the market's willing to give us from a risk-reward perspective. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. Before we start here, this chart looks noisy and intimidating. We're going to take everything piece by piece and go through it, focus on some things in isolation. In isolation, things are very, very easy to understand and can definitely help us manage risk going forward. This is a daily chart of VEU, the Vanguard All-World Index, sans the United States. Why are we using this? It's a good broad brushstroke of risk. If this ETF is healthy, then stocks and commodities and precious metals are probably in pretty good shape. If this index or ETF becomes weak and starts to roll over, it's probably a red flag for your silver, your gold, your copper, and any equity-based investments. The purpose of the exercise here, VEU is in a pattern of some kind. The pattern previously was defined by this pink trend line and this parallel pink trend line. It appears that the current pattern, since we broke the pink trend line here, is defined by this dotted green line and this parallel dotted green line here. And as you can see, we're not that far away from this point here. The purpose of looking at this is we're going to examine this point here and compare it to the present day. What this is the market's losing momentum and getting ready to roll over. So what we'll do when we compare point A here to the present day, first we'll say, does the present day look similar to this pre-rollover period? And I believe the answer is yes, that it does. Then we'll look at what do the indicators, like a MACD, how do they act between point A and point B where this market peaked. Here's where the S&P 500 peaked, so we'll also be interested in what these indicators look like in this period here or in these boxes as these markets rolled over. Big picture, if this pattern holds, and the pattern that we believe we're in now is defined by these green trend lines, and how we know that is, if I were to pull this trend line down to this point here, it aligns very well with this point here. That's not the case if I pull this pink trend line down. It's too high. So this is the line that would most likely act as resistance more so than getting to here. We can study this move from this point here to this point here and learn something about the move from this point here to this point here, if we study that and the analogy holds. And this assumes that we would peak somewhere in this area here. And we're not forecasting that. The purpose of this exercise is to understand if and when we get there, does the present day look like this? Do the indicators look similar? We don't know what the answer will be. It could be yes, it could be no. If it's yes, then we know that we're probably rolling over in a bearish manner. If we get up to this period here, and the answer is no, that these indicators do not look like these boxes, then that's bullish, and most likely we would break to the upside. Now, it's also possible that we've already peaked. If we've already peaked, then that's bearish. If we can't even make it to this trend line here, that indicates a weak market. But the base case is that the S&P 500, VEU, all of these indices will try to make one push higher sometime in the next few weeks. And this would be somewhat of the line of demarcation for the bulls and the bears. And we'll just have to pay attention with an open mind if we get here. Now, if we do some projections with VEU, from this point here to this point here, VEU moved 2.7%. We believe that point A here is similar to the present day. So if VEU were to move 2.78% is the actual number from here, it does take you right roughly to this green line. If we look at the time on a calendar that it took to get from here to there, we would expect, if the pattern holds, that we would reach this line somewhere between October 10th of this year and October 19th. If we do some math with how the S&P 500 is moved, in this move here, the S&P 500 is a leader. In this move here, the S&P 500 is a laggard. The S&P 500 has only moved 76% of the distance on a percentage basis that VEU has moved. So we can do some math and projections. From an S&P perspective, if VEU gets to this line, we would expect the S&P to peak somewhere, or at least reach this similar area between 1489 on the S&P 500 and 1500, and the period would be roughly the same, October 10th to October 19th, somewhere in that window there. Examining the pattern again, here VEU bottomed at both the green and the pink lines. When we bottomed here, we made it all the way to here. Move from here to here. If that pattern were to hold and we were to move from green line to green line, we would move from here to here. And that's the pattern that we believe we're in. There's other similarities. Here you have a downward sloping trend line in VEU that was broken in a bullish manner. Here you have a downward sloping trend line in VEU that was broken in a bullish manner. The breakout took place in a wedge. Here's a rising wedge here. That's a bullish breakout. This breakout took place in a rising wedge. This is a wedge, bullish breakout. So we have similarities there. If we have similarities, do the indicators look similar? Again, we believe that this orange arrow, the present day, this is as of the close on September 21st, is similar to this point here, which is February 13th, the day before Valentine's Day earlier in 2012. We're going to compare numerous indicators here, try to get an idea of, does point A look like the present day? Let's start with MACD. Point A, which is where we believe we are now, you can see MACD, black is above red, but it's starting to show some weakness. Present day, black is above red, but it's starting to show some weakness. So this point does look similar to this point. You can see the histogram here is also starting to show some weakness relative to the high. Present day, the histogram is showing some weakness. We move down and just look at the histogram more closely. This is point A before the market peaks in the present day. They do look similar. This is an indication of slowing upside momentum, an indication of slowing upside momentum. Let's go back down to RSI here. This is RSI. This is point A, which we believe is similar to today. So we're still comparing the orange arrow to the present day or the other orange arrow. This too looks very similar. RSI breaks above 70 into quote-unquote overbought territory, and then it comes down out of overbought territory. Here, RSI is above 70 or in overbought territory, and it moves down below. So this point here, point A, with RSI looks similar to this point here. If we move down further to Williams percent R, we do have some similarities. We have Williams percent R clearly showing strong momentum to the left of the orange line here, and then it breaks below negative 20 here at the orange arrow. Something similar here. We've got positive momentum. This actually looks a little bit weaker than this momentum here, which makes sense for this reason. Why is that? Let's go back up here for a moment. This is a steep increase here. It only took 79 days to move from the green line to the green line. That's not true. 79 days to move from this point here to the orange arrow here is 79 days. To get from the green line here to this orange arrow, it took 112 days, or 42% longer than this move here. That's a good sign, not a bad sign. Markets that are rising in a vertical or steep manner, this trend is much, much more difficult to sustain. This trend here is easier to sustain and probably has a higher probability of moving higher versus a market that moves straight up or at a steep slope tends to come back down in a similar manner. Let's move back down to Williams percent R. It looks similar is the point. Rate of change, similar situation, a little bit. This rate of change might actually look a little bit better here. Here, when we get to the orange arrow or point A that we believe is similar to this point here, rate of change here is making a discernible lower high. So the rate of change here looks a little bit worse than the present day. This looks a little bit more bullish. Now if we come down to the Copic curve, you can see the Copic curve here starting to roll over. This looks a little bit worse than this as well. Now let's look at what we might look at going forward. If, when we move from point A to point B, the market is losing momentum and we roll over, what would we want the indicators to look like in a rollover process? Well, in a rollover process, you can see as VEU advanced here from point A to point B, and we believe we're near point A now, Notice MACD during this move from here to here looks weak. Black actually has a bearish cross. It's starting to roll over, and look in this box. MACD looks very, very weak. So in the present day, if MACD looks like MACD inside this box, then we should be concerned. If going forward MACD looks different and goes on to make higher highs and doesn't look like this, that's bullish. So either way, we can learn whether or not this pattern holds or we break above it. If we're going to break above it, then MACD won't look like this. Histogram, same situation. The red flag case in the MACD histogram is that histogram drops below the center line. This looks very, very weak. So what you have here is you have from point A to point B, the market is advancing, but here MACD histogram looks extremely weak. So again, if histogram over here starts to look like this, that's a red flag. If histogram rebounds and moves higher and stays above the zero line, that's bullish and tells us that possibly this pattern may be broken. As far as patterns go, patterns remain in force until they're broken. Even if we're in a bull market, this market is not going to stay within the confines of these green lines. It will change. It will either become more bullish, more bearish, and roll over. The pattern may or may not hold here. The point of the exercise is to help us understand going forward. Does it look similar to a rollover, or does it look more similar to a market that may move higher? RSI, this would be big. RSI, you can draw trend lines. Notice between point A that we believe is similar to this point here in the present day. RSI, when the stock market subsequently moves higher from this point to this point, come down here, notice RSI, while the stock market, or VEU, is moving higher, fails to clear 70. This is a bearish divergence on RSI on a daily chart. Price is moving higher from point A to point B. This is point B. Whereas RSI is making a lower high. So if the stock market moves higher or VEU moves higher and we see a bearish divergence, that's a red flag. If RSI breaks back above 70 and even makes a higher high, that's bullish, and it tells us that this scenario probably won't play out. So either way, bullish or bearish. We don't need to forecast here. What we're trying to learn is what to look for to manage risk in our client accounts more effectively. Williams percent R. This is what we believe the present day looks like. Notice momentum here in Williams percent R as the market's peaking gets spiky. These are skinny spikes. This here, this is confident upside bullish momentum. This is a conflict between the bulls and the bears. Bulls push it higher, bears push it down. Higher, push it down. Very skinny spike here, bearish. This is where the market peaked here. So going forward, if we see skinny spikes in Williams percent R, that's a red flag. If Williams percent R comes up and looks more like this, or even this, that's bullish. This is point A and rate of change. This is where the market peaks here. Notice rate of change never makes a discernible higher high, and as the stock market from this orange line here is rising, point A to point B, orange line to red line. Let's come back down to our rate of change, Rate of change, divergence. Rate of change is not moving higher. Rate of change is already in a bearish trend. So going forward, if rate of change drops off, similar to this red box here, that's a red flag for risk. If rate of change goes on to make a higher high here, that's bullish for risk. Similar situation with the Copic curve. The Copic curve, this is point A. If the Copic curve rolls over and starts to look like the period inside of this orange box, that's a red flag for risk. If this Copic curve can turn back up and make a higher high, that's bullish. We'll argue here, the Copic curve, during uncertainty in Europe, and we have no QE going on in the United States here. We have Operation Twist going on here, which is mainly some type of Fed propaganda to make the markets believe something's going on. Operation Twist is radically different from what they're doing now. Operation Twist isn't really money printing in the purest form. QE is. Here we have problems in Europe. Here we have problems in Europe. Notice this is different here. The Copic curve here never comes down and looks like this this yellow box or the orange box. So this here argues for potentially higher highs. This Copic curve here also looks a little bit healthier than it does here. It's already rolling over at point A, not really rolling over yet. So if we see it roll over, that's bearish. If it can move higher, that's bullish. This is a daily chart of the S&P 500. This is the beginning of 2012. This is the spring peak. Purpose of showing this chart, the next chart we'll review will be the S&P 500 divided by TLT, which is risk on divided by risk off. There's a lot of similarities on the next chart to this point here and this point here, which would be 8 or 9 trading sessions away from this peak. So if it took us 8 or 9 trading sessions in the present day, we would peak on October 3rd or October 4th. It's not a forecast. It's a baseline. It's something to watch. It's something to understand. Also here, silver, you'll notice, peaked before the stock market. Another thing to keep in mind. My guess would be that silver in this period, since we've got QE now, and we we're very, very close to the European Central Bank printing money along with the Fed. That's quite a bit different than what we have here. So my guess would be that silver would either peak simultaneously with the stock market or even after the stock market. But we'll just have to see how the indicators look. But the next chart could be extremely helpful to us in terms of managing risk going forward. We don't care which way it goes, bullish or bearish. We just want to understand what's happening. Here's our SPX divided by TLT. Think of it as risk on versus risk off. When the line is rising or the ratio is rising, stocks are in favor relative to bonds. When the ratio or line is falling, bonds are in favor relative to stocks. This is what risk on looks like. This is what risk off looks like. As a reference point, this is the period on the VEU chart that we think looks similar to today. This is where VEU peaked, and this is where the S&P 500 peaked in the spring of 2012. Point of the exercise, we want to compare the present day to this topping process between this orange, red, and purple line here. This is the process where the stock market rolled over and we converted from risk on to risk off. If we move down here, this is where the S&P 500 peaked. I think you could make an argument that the present day MACD looks similar to this point, roughly right in here, relatively close to where the stock market peaked. MACD histogram, same argument. This present day histogram looks similar to this. Stock market peaked soon thereafter, 8 or 9 trading sessions later. RSI, this is RSI for the risk on, risk off ratio. Overbought above 70, move below it. Overbought above 70, move below it. Probably somewhere in this area. Here is where we'd be, again, 8 or 9 trading sessions before the stock market peaked. Williams percent R from a momentum perspective, above, below, similar roughly to this point. Here in the present day, rate of change comes up from below the center line, starts to roll over. Looks somewhat similar to this period in here. This is where the S&P 500 peaked. Come down to the Copic curve. Here, it was already flat and rolling over. This looks a little bit better This point here is similar to this point here, which again is relatively close to where the stock market peaked. We don't care which way this goes in the present day. We just want to have a reference point. So if present day MACD starts to look like this, that's not good. If MACD starts to look more like a rising trend, that's bullish. If the histogram drops below on this ratio chart, that's bearish. If it stays above and moves higher, that's bullish. RSI, same situation. If it starts to taper off and fall off, that's bearish for stocks and bullish for bonds. If it continues to hold roughly 48 to 50 and moves higher again, that's bullish for risk. Williams percent R, we don't want to see Williams percent R in this area here on this ratio chart. We'd prefer to see Williams percent R look something like this, where it tends to hold the upper bound and stays out of this area. We want to see white space here going forward. Rate of change, we'd like to see rate of change stay above the center line. We don't want rate of change on this ratio chart to look like this. This is where the S&P 500 peaked. We'd prefer it to stay and look more like this here, where we're rallying in stocks. The Copic curve, don't want it to roll over. If it starts to roll over like this, we would be concerned. If it can look more like this when we're rallying, that would be better, or even better, more like this. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.